Most people misunderstand gold because they look at it like a lottery ticket. They want the world to become frightening on Monday, gold to explode on Tuesday, and their portfolio to become brilliant by Friday. That is not how the metal usually works. Gold is not a slot machine. It is not a meme. It is not a prophecy. It is a very old mirror, and like most mirrors, it can be cruel before it becomes useful when a crisis begins. Gold often does the one thing that makes ordinary investors feel betrayed. It falls, war breaks out, oil jumps, the headlines become darker. The currency system looks weaker. The government looks more indebted. The average saver becomes more nervous. And just when the crowd expects gold to rescue them, the price suddenly drops. That is the moment when the amateur says, gold failed. The professional says, liquidity arrived first. There is a difference. When people panic, they do not first buy what is wise. They first sell what is liquid. They sell what has a bid. They sell what can be converted into cash today, not next month. Gold has been trusted for thousands of years, partly because it can be sold when almost nothing else can. That trust makes it strong in the long run, but vulnerable in the first moments of panic. A man who needs cash by Friday does not sell his lake house. He sells the asset that someone will buy by lunchtime. That is why gold can fall in the middle of a crisis. Not because the crisis is fake, not because gold has no role, not because the world suddenly became safe. It falls because in the early phase of fear, cash is oxygen. And when people need oxygen, they will sell even the things they love. I have seen this pattern repeat in one form or another for a lifetime. Oil shock, war shock, inflation shock, credit shock. First comes the event, then comes the scramble for cash, then comes the rising yield, then comes the stronger dollar, then comes the forced selling. Only after that does the deeper reason for owning hard assets usually reassert itself. The crowd wants one clean story. Crisis equals gold up markets. Almost never give you one clean story. Markets give you sequence. That word matters. Sequence is what separates the person who panics from the person who prepares. The same event can destroy one investor and create an opportunity for another, not because one is smarter in some grand philosophical sense, but because one understands the order in which money moves. I call the first mechanism the oxygen scramble. When a geopolitical shock hits, the first price that usually screams is not gold. It is oil. Oil is not merely a commodity. Oil is a tax hidden inside almost every other price in the economy. It touches transportation, fertilizer, shipping, plastics, food distribution, military logistics, airline costs, trucking costs, manufacturing costs, and the monthly budget of a family that already feels squeezed. When oil rises sharply, the market does not wait for tomorrow's official inflation report. It immediately starts adjusting expectations. Expectation is the fuse. The Federal Reserve may not move its policy rate that day. Congress may not say anything useful that week. But the bond market is already doing arithmetic. If oil is higher, inflation may stay higher. If inflation may stay higher, interest rates may remain higher. If interest rates remain higher, the opportunity cost of holding a metal that pays no coupon rises. That is where many people get confused. Gold is often called a safe haven, but it competes with other havens. If a treasury bill pays a high yield, and the market still believes the United States government will honor its debt in nominal dollars, large institutions may prefer that yield for a while. They can tell their committee they moved into government debt. They can tell their board they are earning interest. They can tell their clients they did something conservative. Gold does not offer that comfort. Gold sits there. That is both its weakness and its strength. It does not promise. It does not flatter. It does not send you a dividend check. It simply refuses to become someone else's liability. But in the early phase of a crisis, Wall Street often chooses the instrument that pays interest over the object that pays nothing, that can push gold lower at the exact moment. Television commentators are shouting that fear is everywhere. I call the second mechanism the dollar squeeze. Gold is priced globally in dollars. When the dollar strengthens, gold becomes more expensive for foreign buyers, even if its dollar price has not changed. And in many crises, the dollar strengthens first because the world still runs toward dollars when it is frightened. That sentence can be uncomfortable for people who believe the dollar is doomed tomorrow morning. The dollar has serious long-term problems. The debt is large, the deficits are large, the political discipline is weak. The purchasing power of cash has been quietly punished for decades, but a currency can be long-term vulnerable and short-term dominant at the same time. That is one of the great traps in macro thinking. People assume a weak future means a weak morning. It does not. When global investors need to settle oil bills, margin calls, corporate obligations, trade finance, emergency funding, and government reserves. They often need dollars. Now, not theories, not essays, not gold bars in a vault. Dollars that short-term demand can strengthen the dollar, even while the long-term argument for owning hard assets improves. So the frightened investor sees the world getting more dangerous and gold going down, and he thinks something is broken, nothing is broken. He is watching two time frames fight each other. The short-term demand for dollars is beating the long-term concern about dollars for a while. I call the third mechanism the profit evacuation. When an asset has already had a large run, it contains stored profit. Stored profit is wonderful when everyone is calm. It becomes fuel for selling when people need cash. Imagine an institution that bought gold much lower and has a large gain. A crisis hits. Other positions are down. Clients are nervous. Margin requirements rise. The investment committee wants liquidity. Which position do they sell? They sell the one with profit. They do not sell because the long-term thesis died. They sell because the portfolio needs cash. They sell because a gain is a piggy bank. They sell because it is easier to explain taking profit in gold than realizing a terrible loss somewhere else. This is how an asset with a strong long-term thesis can suffer a sharp short-term decline. You must understand that distinction, or the market will train you like a dog. Up will make you greedy, down will make you afraid. Headlines will become your owner. You will buy when the crowd feels safe and sell when the crowd feels disgusted. That is not investing. That is emotional obedience. Gold punishes emotional obedience. Silver punishes it even harder. Silver is gold. As more restless cousin, it has monetary history, but it also has industrial demand. It responds to inflation fear, but it also responds to economic slowdown. It can move with precious metals one month and with industrial metals the next. That makes it powerful when the move is right and violent, when the move turns against you. A person who buys silver without understanding volatility is not investing in a hedge. He is stepping into a boxing ring because the poster looked exciting. The same is true for miners. A mining company is not the metal. A miner is a business with labor costs, energy costs, political risk, management risk, reserve risk, permitting risk, and execution risk. When gold rises, a good miner can rise more because its profit margin expands. If it costs a company $1,400 to pull an ounce of gold out of the ground and gold sells for much more than that, every additional dollar in the gold price can fall powerfully toward profit. That is operating leverage. But leverage cuts both ways. If gold falls, costs do not politely fall at the same speed. If fuel gets more expensive, if labor costs rise, if a government changes royalties, if a mine disappoints, that miner can suffer even when the metal thesis remains intact. That is why I never want a man to confuse a gold miner with gold. Gold is no one's promise. A miner is a promise made by management, geology, politics, and accounting. Those are very different things. Now, royalty companies sit in a different place. They often finance miners in exchange for a slice of production or revenue. They do not usually carry the same direct operating burden as the company digging the ground that can make them cleaner. In some respects, but even a royalty company is not magic. It still depends on mine production, counterparties, reserve quality, and the price environment. There is no asset class where ignorance becomes safe just because the story sounds conservative. That brings me to the real lesson. The opportunity in gold is usually not found when everyone is celebrating gold. It is found when the people who bought it for the wrong reason are being shaken out. There are four phases I watch in moments like this. The first phase is the headline shock. Something happens: war, oil, banking stress, currency, fear. Everyone expects gold to rise instantly. But the first wave is often disorder, not wisdom. The second phase is the liquidity drawdown. Yields rise, the dollar firms, institutions sell winners, and the metal falls. Retail investors become angry because they thought they bought protection and instead received volatility. The third phase is the quiet absorption. Forced selling slows central banks. Long-term allocators and patient buyers begin to step in. The news may still sound poor, the chart may still look ugly, the crowd may still be tired, but the balance of supply and demand begins to change. The fourth phase is the recognition move. The market finally notices what the patient money noticed earlier. Gold begins to recover. Silver follows more violently. Miners that survive the shakeout begin to reprice. Suddenly the same asset that nobody wanted during the decline is described as obvious. Nothing is obvious until after it has already rewarded someone else. That is why the average investor keeps arriving late. He waits for confirmation from price, then he pays the confirmation premium. A patient investor studies the structure before the applause returns. Now, I want to be careful. I am not saying every pullback is a gift. That would be foolish. Sometimes an asset falls because the thesis is broken. Sometimes demand is exhausted. Sometimes a mine is badly run. Sometimes a commodity becomes crowded. Sometimes the chart looks like opportunity and the business underneath is deteriorating. You do not buy because something fell. You study why it fell. There is a difference between a discount and a warning label. A discount is a good asset being sold by someone who needs liquidity. A warning label is a bad asset being repriced by reality. The market offers both, often in the same week, and it is your job not to confuse them if gold falls, because real yields are temporarily rising, the dollar is temporarily strong, and institutions are taking profits after a large run. That is one kind of decline if gold falls, because inflation fear disappears, central bank buying collapses, investor demand vanishes, and competing yields remain attractive for a long period. That is another kind. The price alone does not tell you which one you are seeing. The work tells you this is where many people lose their way. They want a single number. They want someone to say, buy at this price. They want certainty in a business that only offers probability. The better question is not, will gold go up next week? The better question is, what conditions would make gold more valuable over the next several years? And are those conditions strengthening or weakening? Ask that. And you start thinking like an owner of capital instead of a consumer of headlines. What are those conditions? First, persistent fiscal weakness. A government that spends far more than it collects must borrow, tax inflate, or some combination of the three. None of those outcomes makes long-term cash especially attractive. Second, central bank diversification. When central banks want less dependence on a single reserve currency, gold often becomes attractive because it is neutral. It has no flag printed on it. It cannot be sanctioned in the same way a bank deposit can. It does not require another government as promised to exist. Third, negative real returns if inflation runs above the safe interest available to savers, the savers being quietly taxed. Gold has historically gained attention when people realize they're safe. Money is losing purchasing power after inflation. Fourth, geopolitical fragmentation. A world with more conflict, more sanctions, more mistrust, and more broken supply chains tends to value assets that sit outside another party's credit system. Fifth, crowd disgust after a pullback. This one is behavioral, but behavior moves prices. When a fundamentally useful asset becomes emotionally hated after a decline, the future return often improves because the weak owners have left. These are the things I would examine. In fact, I become suspicious when fear is being sold too aggressively. Fear can be profitable for the person selling the newsletter, the coin, the seminar, the trading system, or the miracle chart. Fear is a business model. Do not become its customer without doing your own arithmetic. The best reason to own gold is not panic. It is humility. You own a little gold because, governments can make mistakes. Currencies can be diluted. Central banks can be trapped. Politicians prefer easy promises to hard arithmetic. Wars can arrive faster than budgets can adjust. The future can embarrass the smartest people in the room. Gold is not a prediction that civilization ends. It is an admission that civilization is managed by human beings. And human beings are not always careful. The forced seller is the market's favorite meal. If you are forced to sell because you use leverage, because you borrowed against volatility, because you put emergency money into speculative miners, because you bought silver with rent money, or because you confused excitement with allocation, then the market will not negotiate with you. It will take the price it wants. That is the part young investors often miss. The danger is not volatility. The danger is volatility plus obligation. A 30% drop in an asset, you understand, sized properly with no debt attached, can be uncomfortable but survivable. A 30% drop in an asset you bought with borrowed money, emotional conviction, and no plan can ruin you. Same price move, different outcome. The difference is structure. Now let me talk about the 200-day moving average, because people either overuse it or ignore it. A moving average is not a magic line. It does not know the future. It does not sit in heaven issuing commandments to traders. It is simply a way of seeing whether an asset has moved meaningfully away from its longer-term trend. Large institutions watch these levels because other large institutions watch them. That makes the level matter, not because it is sacred, but because behavior can cluster around it. When gold or silver falls sharply below a long-term trend after a major run, the crowd sees damage. A patient analyst asks whether the asset is being sold for temporary liquidity reasons or permanent thesis reasons. If the selling is temporary and the structural buyers remain, then the distance below trend can become interesting. But interesting is not the same as immediate. One of the hardest skills in investing is waiting after you have noticed something. Most people think the work is finding the idea. That is only the first piece. The second piece is waiting for the right price, the right structure, and the right risk. The third piece is sizing it so a wrong outcome does not injure you permanently. I have never met an investor who became rich because he had to act every morning. I have met many who became rich because they could wait while others exhausted themselves. In metals, that patience matters even more. Gold can frustrate you for years and then move violently in months. Silver can sleep like a stone and then behave like a racehorse. Miners can look dead before they double, and they can look brilliant before they collapse. If you do not have a process, the volatility will become your process. And volatility is a terrible boss. The process I would use is simple enough to state, but not always easy to follow. First, separate the asset from the vehicle. Physical gold, gold ETFs, silver ETFs, miners, royalty companies, and leverage products are not the same thing. They may respond to similar forces, but they carry different risks. Second, separate the thesis from the timing. You can believe gold belongs in a portfolio and still believe the entry price matters. You can believe miners have upside and still wait for a better setup. Conviction without price discipline is just expensive enthusiasm. Third, separate hedge money from opportunity money. A hedge is sized so it protects you. A speculation is sized so it cannot destroy you. Mixing those two buckets is how people turn insurance into a casino. Fourth, watch who is selling and who is buying. If weak hands are selling and strong hands are slowly accumulating, that is one picture. If everyone is leaving and the structural bid is gone, that is another fifth. Never use a crisis to discover your risk tolerance. Discover it before the crisis, write it down, decide what you can hold through, decide what would make you sell, decide what would make you add. Do it before the red numbers arrive. The red numbers are not the time to invent a philosophy, they are the time to execute one. Now, why do I keep coming back to central banks? Because central banks are not buying gold for a quick trade. They are not trying to impress a neighbor. They are not posting screenshots. They are not asking whether gold will be up next Thursday. They are thinking in decades, reserves, currency risk, sanctions risk, and national balance sheets. When central banks become persistent buyers, they create a different kind of demand than a retail trader chasing a breakout. It does not mean gold rises every month. It does not mean there are no corrections. It does not mean you should blindly copy them. But it does tell you something about the longer-term monetary environment that people who manage reserves for countries are saying, in effect, we want more of an asset that is not another nation's liability. That sentence is worth thinking about. It is especially worth thinking about in a world where debts are high, deficits are persistent, and political trust is not exactly overflowing. Now let us return to the bigger picture. Gold and silver are not rising or falling in isolation. They sit inside a world of high government debt, large deficits, uncertain oil supply, shifting central bank reserves, expensive equity markets, persistent inflation anxiety, and a public that increasingly feels that official numbers do not match lived experience. In that world, hard assets have a reason to exist, but a reason to exist is not the same as a reason to overpay. The long-term case for gold can improve while the short-term price falls. That is not contradiction, that is opportunity. If you know what you own and why the long-term case for silver can improve while its volatility destroys undisciplined traders, that is not unfair, that is the asset being itself. The long-term case for miners can improve while weak miners still fail. That is not mystery. That is business quality asserting itself. The question is not whether the world is dangerous. The world has always been dangerous. The question is whether your portfolio is built so danger creates options instead of emergencies. A portfolio built on leverage creates emergencies. A portfolio built on cash, productive assets, and carefully sized hard asset exposure creates options. A portfolio built on headlines creates regret. A portfolio built on process creates patience. And patience is the bridge between fear and profit. I have said it many times that you do not find out who has been swimming naked until the tide goes out. In precious metals, you often find out who had a plan only after the first pullback. The first pullback reveals the tourists. The second phase reveals the students. The recovery rewards the prepared. That is the real pattern. Not gold up, not gold down. not crisis equals immediate profit. The pattern is panic, liquidity, absorption, recognition. Most people buy recognition. The better investor studies absorption. That is where the work is quiet. That is where the news still sounds ugly. That is where the chart still looks damaged. That is where patient capital begins to build a position while emotional capital is leaving. Nobody rings a bell at that moment. There is no parade. There's only discomfort and arithmetic. And that is why it can pay. That is the standard, not excitement, not certainty, not prediction. Structure gold will not save an undisciplined investor from himself. Silver will not forgive bad sizing. Miners will not reward laziness. And no chart line, no matter how popular, will replace judgment. But if you understand the mechanics, if you keep your balance sheet strong, if you treat metals as part of a broader system rather than a bet on the end of the world, then a pullback during a crisis can stop looking like betrayal. It can start looking like information that is all the market ever gives you at first. Information, the profit comes later if you interpret it better than the crowd. And the crowd, in my experience, is rarely patient during phase 2. It is too busy being angry that the asset did not move in a straight line. Do not build your financial life around straight lines. Build it around resilience. The metal may shine, but the real edge is not in the metal. The real edge is in the investor who can watch the shine fade for a season without losing his mind, his liquidity, or his discipline. That investor is rare. And rare things over time tend to become valuable.